Hello and welcome to Trading the Trend. My name is James Boyd. We welcome everyone actually here today. We also got Brent Moores in the chat, a fellow instructor, and you know Brent, so you'll see his initials BM in the chat. We also got Will with us. Hello, Will. We got JP, DT, David. Hello to you. Probability Trader, Elena, Sunita, and welcome to all. So just real quick reminder, you can follow us on X. We do post educational announcements there. We do have some slight schedule changes next week. I'll get into more of the details. I did post my schedule change, which will only be trading growth and value stocks that used to be Wednesday at 4 Eastern. We'll just be moving up 1 hour to 3 Eastern. So Michael Fairborn's class will go from his normal time to our normal time, okay? So this is switching the classes around as far as the times. So we'll meet still next week, Wednesday, on trading growth and value from 4 Eastern. We'll now do it at 3 Eastern. So same day, just 1 hour earlier. Quick heads up. Now, if you also attend Michael Fairborn's class, his class will actually just be done 1 hour later. So minor tweak there. So just real quick, as we get going here, wanted to let you know about that. Did post that on X. That's why you want to follow us there. Also see that Brent has his handle there, Brent Moores CS. Check that out as well. Now, just real quick as we get started, our class really focuses on stocks. Occasionally, we also focus on options as well. We're going to have a balanced discussion on stocks and options here today. Remember that options carry a high level of risk and are not suitable for all investors. The information here is provided for general informational purposes only. And also remember that this webcast discusses technical analysis. There's other approaches like fundamental analysis, which we talked about yesterday. We also talked about inter-market analysis on Tuesday. And I think that is highly underrated, probably the least talked about. And I have no clue why, okay? It's very interesting because you start to really see kind of where investors put their capital. And you start to understand relationships. And we'll talk about that here today a little bit more. Now, also remember that investing involves risk, including loss of principal, and our examples will be done in the Paper Money software application. Now, when we talk about options, if we do short options, those could be assigned at any time up to expiration, regardless of the end of the money amount. We're talking about American style options in our examples. Option Greeks measure sensitivity, and also understand that today we'll talk about kind of just a quick look at the overall market in general. Okay, I do think there's some things we need to keep an eye on. Very interesting price action from NVIDIA to the NASDAQ. I also want to kind of follow through from what we talked about last week, which was the VIX. Want to kind of talk about our fear gauges. Okay, remember those fear gauges? VIX, what are the other ones, right? We'll talk about those here today. And I also want to get into current positions, stock and options, and then new examples. So today is really kind of more about application of like being a trend trader. Now, first off, if you don't know, you can actually go to our YouTube page, okay? And you can just follow us right on YouTube. Now, you can subscribe for free. That way you can actually get all of our content outside the ETF discussions that we do Monday afternoon and Friday morning. Okay, Kevin and I will do the ETFs tomorrow morning at 9:30 a.m. Eastern. Those ETF sessions are not recorded. Now, in terms of actually the playlist here for this class, last week, just so you kind of know the ground that we covered, we called last week's session, Come to James Meeting. James, okay, slight tweak there, on option protection. Okay, that was kind of funny. Option protection strategies and why. Now, in a couple of our examples, we'll kind of bring up how are those callers faring, okay? We also talk about following the trend in re-entry setups, so fearful that investors miss potential opportunity. And also we talked about, we went back a month ago, short verticals during higher volatility. Now, I would also say that this one's been kind of important because what you're going to notice is there's a lot of stocks that have kind of had some neutral trading ranges. And that's a strategy that's really trying to take advantage of time decay. I need you to say that, decay, okay? Now, let's go ahead here and hop right in. Let's start with just real quick the SPX, okay? Now, if I were to kind of zoom in on this just real quick, if I can, and that line that we've been looking at, 56.80, 58.62, We got above that 3 days ago on Tuesday, and it's still holding. Now, where we were last week, okay, we dropped down in the price. So this is where we were last week on the 22nd. We were below the moving average. So much different than where we are now? Not necessarily. About 1% higher than where we were from last week. And then actually the following on Friday, it dropped again. Now, luckily, that pullback didn't last very long. That's not necessarily bad. I think if you're a bullish investor, I don't think you would say, oh no, I want a deeper pullback. I think many investors will say, I'll take it. Shallow pullback, we'll take it, okay? Now, if you kind of zoom in on this, which I'm going to try to, you're going to notice that in the last couple days, sitting right on the 10-period moving average, it turned green, and then today so far, name that candle. Well, it's not perfect. Rarely they are, but it kind of looks like a hammerish candle to me, okay? And hammers can be red bodies or green bodies. Of course, if the investor said which one they like better, they probably like the green body. Noted, but the idea is the same. It can be red or green, irregardless if it's at support, okay? Now, when we actually go back to, let's say, just real quick, the NASDAQ, and that one, which if you looked at the futures overnight, those futures were up actually quite solid. We saw the open on the NASDAQ was pretty much the high of the session. There were some traders that used prior highs as a target area. It opened up near the high, and some investors sold it down near the 10-period moving average, which is curving back up a little bit. Not as much of a hammer as the SPX, but your leader, the NVIDIA, you're going to see that it went up to the top of the range. And why did some people sell? Well, because it went up to the top of the channel, okay? Now, there is a position in the paper money account on that. We'll discuss it in just a moment, but there could have been some active traders that said, hey, my goal was to go up to 143. It broke out there. It retested perfectly there, and it went up to the top of the channel in 4 days. Some investors might say, spank you very much. Now, the risk of that was, how did the investor know it was going to gap up? They didn't know that. They just traded it. They're willing to take the risk, like any given day. So on that, what we see is when we look at the semiconductors still holding, okay, not a big change there. When you look at other stocks in here and say, are they getting a little bit? Micron not getting a bit. So most of the kind of the movement in the space of semis is coming from NVIDIA. Now, the things I think we need to pay attention to, when you look at the VIX, which we talked about quite a bit last week, and let me zoom in on this, we don't see that the VIX actually recaptured really above that 10-period moving average, a little rally and then fades so far, but it's kind of some of these other gauges. Like what, okay? So when we actually take a look at, let's say, gold, and I'm going to use the ticker symbol XAU. You don't have to. But I'm going to use an index which is trying to capture both of those precious metals. Now, if I look at this, tell me what you see on gold, okay? Now, we know that some people, if they're expecting maybe the market to be more volatile, they might buy puts, et cetera, and that could be captured, at least in terms of looking at the VIX. Other people say, look, I'm going to go to a different asset class, like precious metals / commodities, and they might say, look, I'm going to actually buy some precious metals. Now, some might lean to one precious metal more than the other, but if we look at that 1 year daily chart, it kind of looks very flag-like, to say the least. Now, guys and gals, I'm going to tell you right now, if you're only thinking about stocks, you're probably thinking too dadgum small. It ain't just about stocks. Stocks are only one asset class of a few. And if those stocks are kind of more neutral, you might say, what asset class, if you considered it, might actually have more of a stronger trend? That's what experienced investors do. They don't just sit in one asset class because no one ever said you had to. And so if you take a look at this, really in terms of if we use XAU, you don't have to. You can use something else like an ETF. You might use a future. I can't do that in this class, so that's why I'm using the index, okay? And if you look at the breakout, that breakout is actually held. Now, some investors might say which precious metal is actually getting a lift, and that's where I'm having an understanding of futures price could be helpful to say which precious metal. Is it more gold or is it more silver? Okay, look at the price, action, and also look at the percentage returns. Now, we're also seeing that the US dollar here, which is, again, we talk about cash, and if we look at the US dollar, tell me what you see now. Now, by the way, when we talk about gold, as I brought that up, we will swing back to NEM and AEM in just a moment. If you saw the US dollar do this, okay, a little rally to the upside and then push down, what might be a potential trade idea? Where might the investor go look? Now, hold on for a second, okay? We talked about relationships on Tuesday, right? If the US dollar actually goes down, what could go up? What could? Well, maybe gold could go up, right? We talked about that. If the US dollar goes down, think of teeter-totter, right? If the US dollar goes down, what other currency might go up in offset? Well, maybe like the euro, maybe like the yen, maybe like the Swiss franc, right? Maybe like the British pound, something like that. Something just opposite. Because if investors are getting out of all currency, it doesn't mean they're actually converting the currency to bread, okay? Or let's say a phone. They're actually going from one currency to maybe another currency, perhaps, to maybe invest in that currency and or buy something with that other currency. So if you looked at the Swiss franc today, the yen today, you also look at the euro today, pretty strong movements in those currencies with lower shadows. Keep an eye on that. Dollar a little bit under pressure. Okay. Now, did you know? I want to know from our side, because it made me feel horrible if you didn't recognize that today. It made me feel really bad. How many of you saw kind of the movement today in the US dollar, and you saw the movement in the yen? We call it the international VIX. You saw the movement in the euro and the Swiss franc. How many of you saw that? And how many of you are thinking, geez, with the dollar going down, maybe could gold be starting to go up? That's the way I want you to kind of start to think. If one goes down, what could go up? Okay. Think correlation. Some people kind of also call it pairs trading, if you will. Okay. And so I just wanted to kind of keep that in the forefront of our mind. Now, I want to go back to just real quick, if we can. I'm going to go look at, let's say, some of these. Let me just take a look at NEM just real quick. Now, NEM, if we talked about a gold stock, okay, NEM is actually a stock. Now, remember, when you look at NEM, it has a correlation to the index and the sector, of course, but it also has some correlation with gold prices. And we talked about on Tuesday how to do that. The other thing is, if you look at that breakout, it's actually held the breakout. It's not a hold yet, but that's actually something the investor might keep an eye on to see, can it get a bounce after breaking out? If we looked at AEM and said, which one is stronger, what would you say, Kevin? Probability trader, Thea, okay? Would you say AEM is stronger or NEM? Now, as I ask that question, you might be saying, well, how would you know? Well, you're looking really at the right-hand side and saying, are both above the support level? They are. But if you looked at on the right-hand side and said, which ones are showing green candles that could be a close above the high of the low day? Well, it's not NEM, okay? So we could just cross that off. We go back to AEM, and what you're going to notice if we zoom in on this, we have the same type of idea as far as the pullback from the top, pullback from the top, pullback from the top. And what you're now going to notice is this last little breakout area. We label that as the breakout because we want to see the whole body of the candle above the resistance and a green candle. The green candle is telling us that we close higher than where we open. That's the significance there. 2 days after that, doink, there's your close above the high of the low day. And then what you're going to notice is really from there, it's kind of been a little slow grind to the upside with an upcoming dividend. Now, we always got to say this. It's paying a dividend 40 cents on the 30th. You got to remember, though, that dividend could stay the same, could be raised, could be cut. We know that dividends are not promissory future payments at the same level. They're just at that moment in time, okay? Now, what I want to do is, if we were to take a look at this, and what I want to kind of show is, we're going to go back to the trade tab for just a sec. Let me pull up the paid money count. And remember, the investor's job. So let me ask you a quick question, just to make sure we're on the same ground. Why does someone do stock investing? Can anyone explain that? Why does someone do stock investing? Why? Why not just load the boat with treasuries? Well, it's a pretty simple answer. Okay. So if someone said, well, why on earth are we trying to focus on stocks and trying to ride those trends? Now, I'm going to kind of make a quick comment here. Okay. I think a lot of times we assume that we know the answer to this. But if I went to the trade tab for just a second, I want you to imagine that the investor had $1 million. Okay. $1 million. And $1 million isn't as much as you think it is. Okay. Let's just be honest here. We're going to go to the trade tab. Okay. And if the investor said, look, I'm going to take the $1 million, I'm not going to do stocks, and I'm not going to try to ride the trend. I'm just going to park my money in, let's say, CDs and or treasuries. I'm going to loan the money to the government. They're going to pay me back. Okay. Now, if the investor went out for 1 year, park the money in treasuries. Well, it's 4.18% as of right now, assuming it gets filled at that price. Okay. So why does someone do that? Now that 4.18% is a nominal return. That's not the real return, because if inflation is, let's say, 3% from now until next year, well, you get a 4%-ish rate of return less the inflation rate, which you won't know what that is until next year. Okay. And the real rate of return might only be 1%. Now, if someone had $1 million and they got 1%, it's a couple bucks left over. Okay. But why does someone do stocks? Well, someone's actually trying to get a higher potential real return. Okay. Now, whenever you talk about higher potential returns, tied to that string is also a higher fluctuation risk. It's called volatility. Okay. Now, the biggest thing is what we're going to do in this case is that is why we're doing stocks. Okay. We're not making comments like we love the stock. We're in the stock market. We're trying to buy some stocks in the stock market or do options on those stocks to try to get a higher rate of return than some other asset classes. And the key is a higher real rate of return. The return less the inflation rate. Okay. That's why people focus on stocks. The other thing is they might have a longer investing holding period where they can invest, and they might not need that capital, let's say tomorrow, the next week, and so on. Okay. A little bit longer investing time frames a lot of times. Now, what I'm going to do is I'm going to right click on this chart. Okay. Now on that, I'm going to go to the AEM, pull it up, and I'm going to right click on this chart. In our first example, we're just going to buy some shares of stock, and we're going to try to see if that stock can't swing its way back to the upside. Now, of course, okay, if we brought this back up and said, does AEM have any correlation to gold at all? Well, we can go back to studies, add study, compare with. Let's just type the XA, it's defaulted to XAU, pull it up, and what you're going to see is there a correlation with AEM and gold? The purple line is the XAU. The candlestick chart is AEM. Now, some people would say, I would like to buy gold, but I don't do futures. Second, I can't buy the basket that tries to track the price. Well, that's not the only way you could play it. You could actually try to play the AEM, which has recently a correlation to that. Okay. So if I kind of said, okay, I'm going to take this off now, which has shown a history, could that continue? So clearly, if someone is actually buying AEM, it's not just what they think the company could do. They're actually thinking that gold could go up and AEM might benefit from that. Now, what we're going to do is we're going to say, what's that prior high? It's about 125.88. Okay. So when we're talking about trading the trend, sometimes you're just looking for a little bounce and a little swing back up to that prior high. This is not counting on an extension, a brand new high. This is just saying, come on, be nice. Can you at least go back up to the prior high and just touch? Okay. And even if it becomes a resistance, just try to sell into that prior high. Now, if we kind of looked at kind of a recent plateau area, what you're going to notice is kind of for a support area, the last couple of days, we've kind of had some sideways price action. That sideways price action is about 115.28 or so. So 115.28, less 2%. If we did that, 112.97. Okay, 112.97. Now, what I'm going to do in this case, go daily GTC, and I sure hope there's enough capital in this account. We're about ready to find out, okay? If I put $6,500, which is the full position size, it's going to be about 54 shares. Now, if I click on that and say I'm going to put 54 shares, now that we know what that is, for $6,500 worth on a $118 stock, 54 shares, we got a limit price, buy at that price or lower. The problem is, as we talked, the stock moved up a little bit. It's up 13 more cents. This is the limit price of what it's able to buy at. So we're going to need the stock to come down a little bit so we can get filled, okay? And I hate when it does this. And this is why sometimes I talk a little faster. I'm going to kind of just double check these numbers. So what I'm going to do is I'm going to unlock that, and I'm going to type in the price again, 125.88, and then 112.97. Okay. Now, what I'm trying to do is kind of move that price up. Now, if I would have just typed in the price, it's going to move the orders of the target and the stop. Confirm and send. Read what's in red there. Okay. With the stop price, if that's okay, I'm going to try to send the order. Notice that it's sitting right there. Okay. Now, the biggest actually thing is someone might have said, well, how would we have known what stocks are in the gold space? And by gosh, it's really a quite easy answer. It really is, okay, when we think about it, okay? So we went to scan for just quickly, okay, scan. So look, give me a stock that's greater than 30 bucks. Give me a stock that, for example, give me the volume. Now, this is the volume now, okay? This is not average volume. So if we said, look, we need to have a minimum 250,000. Now, if you run this, let's say at the first part of the day, then and you're 30 minutes into the market, you got to understand something here is that, 250,000 shares in the first 30 minutes of the market might be a little high. I'm going to take off this third row because we don't need it, okay? And I'm just going to say, look, go to scale in, buy industry, materials, and we're going to say, give us those metals and mining stocks. Now, if you actually said in this case, hey, what I want to do is I want to go ahead and actually only pick the ones that are precious metals or gold or silver or copper, if you want to try to nail it to that degree, there you go, okay? I'm not going to do that. I'm just going to say hit us with precious metals and mining and say scan. And from there, we're going to get a list of stocks actually back where they're over 30 bucks. The volume is 250,000, and that's the volume today. And then we'll get a list back, okay? So that's not that bad. Now, Adish says, why buy shares and not spreads? Well, so here's the deal. My simple answer to that question is the following. As long as the stock is liquid, and those options are also liquid, okay? So what I mean by that is there's sometimes when we look at the stock volume, let's say the volume was only 10,000. Well, if the stock volume is not high enough, then the option volume is highly likely not going to have liquidity either, okay? Now, wonder if the stock volume is pretty high, does that guarantee that the option volume is going to be high as well? Not necessarily, okay? So, but this is probably the greatest indicator, stock volume, average volume, okay? Stock volume, we're talking about volume right now, okay? Today so far, average volume over the last 30 days and so on. That's probably the greatest indicator as far as are the options liquid, or do they at least have probably some tradable options, okay? Now, in our example, if this is high enough, let's say 1 million shares or higher, could the investor go do the options? So in most of our cases, we're looking for options that really actually have 20-cent wide bid-ask spread at the widest in most examples. And we're probably talking about an open interest and a volume that could be in the couple hundreds as well. If we got that option volume in the open interest high enough, that really goes back to what I first said, which is the bid-ask spread probably no wider than 20 cents. Now, why is it not always that way? Well, because if we pick a higher dollar stock, you have a greater chance of the bid-ask spread is going to be a little higher sometimes, okay? So you just got to understand that. So now, so in our examples, we always try to choose typically stocks that have a lot of volume. And then if the investor said, well, why not do an option versus a stock? And my answer to that is, as long as it has enough stock volume, it could be an option trade too, okay? Now, but why would someone pick like a stock trade? Number one, what? So does anybody know the answer to that? What's the answer to that? What's a big answer to that? I can think of three of them. Number one, they might want the dividend, okay? Number two, they don't want an expiration, okay? Maybe they want to actually take an investment that really has a longer holding period potential horizon. They don't want expiration every 60 days. They want to try to hold on to it for longer. And I think the third point is when you look at, let's say, stock versus option, if the investor, let's say, buys 54 shares of stock, if that stock goes up $1, they're going to be up $54 unrealized gains. If the stock goes down $1, they're going to be down $54. Okay? You got 54 shares, stock goes up 1 or down 1, there it is. In other words, they're getting 100% of the movement. You could also think about like the delta is 100. Okay? With options, you're not getting typically 100% of that move. You're getting a fraction of that move. Now, let me kind of say one thing just real quick. So why, again, would an investor buy a stock? There's some times the investor says, look, I'm pretty daggum confident on this move. I don't want 20% of the move. Okay? I want 100% of it. Now, if they're wrong, they're going to get 100% of it. Okay? But sometimes the investor really wants a bigger, they want to pick a strategy that's more sensitive to direction. And we say that, that is called delta. Okay? Does that make sense? All right. Now, that's a great discussion. So now, have you ever actually looked at a stock and said, man, I don't want to do like a vertical that has a 10 delta, or I'm only getting 10% of the movement up or down initially. I want something that if I get the direction right, I could be rewarded for that. Well, that's why people do stocks. Now, you could try to synthetically replicate that, and that's just called the long synthetic, right? But even that has expiration, and even that has no claim to the dividend, okay? So now, speaking of that, now Lisa's here. I think this would be kind of funny. Lisa, this is funny. Okay, I say this okay. You know, there's some stocks that maybe the investor says you just need to leave it alone. Okay, you just need to leave it alone. You've had 2 cuts at that ball and you whiffed both times. Now, there's been a stock. Now, normally we don't really talk about healthcare stocks that much, but let's say the investor said, you know, James, maybe instead of, let's say, buying shares of stock, let's say the investor said, look, I want to do like a vertical, okay? Like a long call vertical. So example given, let's say the investor said, look, I'm going to try to place a bullish trade on Gilead. Okay, now Lisa's saying, James, don't do it. I'm red hair and freckles, okay? It's just what I can't let it go. Now, it was kind of funny the other day to show you how my traits are being passed on to my grandkids. My first grandkid took my son's facial razor, okay, for his beard, and then proceeded to take a chunk out of her hair, okay? And so, you know, if you're Irish, you kind of know that you like to play with fire sometimes. And so now my granddaughter, you know, she's missing a chunk of the side of her head. Anyway, you know, she wasn't hurt or anything, but it's pretty funny, okay? So we call her Ruby Sue now, if you know that show. Okay, and I'm going to touch this stock. So Lisa, we're going to practice one more time on this, okay? Now, what I'm going to do on this, and let's go back to this. Let's say the investor said, James, I'm going to go out 20 days to expiration, okay? 20 days to expiration. And let's kind of look at the volume, okay? So the volume on the stock is 2.3 million, all right? So what does that probably get us to think? Well, probably thinking, now, by the way, if I went down to the implied volatility on the right-hand side, the higher that implied volatility is, that might maybe make it harder to get a tighter bid-ask spread. I mean, if we saw like implied volatility over here, like 200, I mean, we'd probably guesstimate that those spreads might be wider, okay? This is not super high, but anything above 35 is probably getting there, okay? Bid-ask spread, please, 10 cents. So when we look at the bid-ask spread, we're really looking at, let's say, the at-the-money strikes. The stock is at 110, call, 10 cents, 25 cents. No, or you could also look at, let's say, which option would you consider? Now, let's say the investor said, you know what, and I'm going to show this example. Notice when we look at the volume, 81 contracts today, that's today. That could be contracts that were bought or sold. And then this open interest, that's the number of contracts that are still open and unexercised, okay, that are still out there, where people are long and short. That it could be future liquidity where people close their long positions or buy back their short positions, okay? That is also kind of important because you want to know, could that be future liquidity if the investor is looking to match to someone else who has the opposite side of the trade, okay? Now, what I'm going to do in this case is I'm going to click on this 510. Now, the one thing that's kind of interesting about options is if the investor said, look, I'm going to buy a call. Well, if you buy a call, the at the money, it typically has a delta probably between 50 and high 50-ish, okay? We bought at the money, okay? Here it is, delta 55. Now, options are interesting because depending upon the strategy, the delta can have a different amount of change. The different amount of change of delta is gamma, okay? Gamma, how much the delta is changing by on a $1 move in the stock price, up or down. So if I actually went to this just real quick and let's kind of show this. So I do not want to give anyone the impression that, hey, wonder if you like to buy long calls. Okay, there's some advantages to that. So the first dollar movement up, 55 cents. The second dollar move to the upside, adding 4% chance or 4 delta, it's 59. And if it goes up again, it's approximately 63 and 67 and 71 and so on. And it can cap out all the way to 100, which is pretty amazing because if that delta, let's say, went up, let's say if the stock went up $1, $2, $3, $4, $5. If the stock goes up $5, does the stock have a greater chance to expire in the money? And we would say, well, geez, if it went up to now 115, there should be a greater chance to expire in the money, hence the delta went up. Now, if the stock went up $5 and the delta is 71 and the investor said, James, I paid $5 for the option originally, well, that $1 move is like 15%. And this is what blew my mind, okay? I remember there was a stock called Potash. And we did this example one time where we bought this call for $1.35 with like a 30 delta. And it went up to like $32, a 30 bagger, whatever you want to call it. It was a big bag. And the biggest actually thing is, what blew me away is when that delta went up to 100 and we only paid like $1.35, it was almost 100% gain, almost 100% gain on a $1 move. So in other words, when it goes right in your direction, it could be unbelievable. If it goes to the downside, it loses, but it's at a diminished amount because the delta can only fall to 0. Okay, this is interesting stuff. Okay, it really is. This is why people are saying, James, if I can get that first $1, $2, $3, give me a little push to the upside. Get me into that $4, $5, $6, $7, $8 move where that delta is pretty big. $1 move on the stock could be a 15% move on what the investor paid. So why do people trade options? They're saying, James, if I can even get that first $3 to $5, that percentage gain and or loss could be pretty big. They're trying to play the percent. Okay. I'm going to come down from the soapbox there. But I'm telling you, that's what's interesting about strategies. If you did verticals, you're not going to get that because you're on both sides of you're buying something and selling something. If you do long call options, long put options, and we're talking about single options, the delta could accumulate or go the opposite direction. Okay? So the delta is 0 and 100. Okay? Delta of 0 means no sensitivity in the short term to direction. Delta of 100 actually means if it goes up $1, you can make $100. Unrealized gain goes down $100, goes down $1, could be down $100. Okay? So you should have an understanding of why different strategies. The simple, clear-cut thing is, why do investors pick higher deltas? It's when they're more confident in the direction of that stock. You probably have some market wind behind you that's helping you out a little bit, and the sector. And the biggest actually thing is that's why they're doing that, okay? And they're okay with saying, look, I know this is only a trade for 22 potential days. I don't have to hold it to then. But they're okay with just having a shorter term duration trade, okay? Now, in this example, let's show that, okay? So just remember, the delta was 55 when we started. We're going to try to buy that call for about 490, okay, in the middle between the bid-ask spread, long call, okay? Notice right here is I'll actually put that order in, and we're going to try to get it filled at 490, okay? Now, let's kind of also go back to another example here. I want to kind of take a look at, tell me what you see in Boeing just real quick. Anything on Boeing? So we went back to Boeing. Does anyone kind of see that maybe is 198.95? Could that be becoming new potential support? Okay. Now there's a couple reasons why Boeing could actually go up. Historically, the fundamentals were absolutely, I'll leave it where you could describe it for yourself. Okay. They printed so much red ink. Okay. I'm talking about negative earnings per share, okay? Negative earnings per share, negative earnings per share, negative earnings per share. And that CEO, I don't know, what was he getting paid, like $20 million a year? I think many investors would say, James, I could be the CEO, okay? And I could make $200 million or whatever they got paid, and I could print red ink too. Hey, maybe they were applying. Maybe they had the job opening. Now, if we take a look at this, we know that the price went up quite a bit when the market was up higher, and then it faded back. Zoom in on this. You're going to kind of notice a little run to the upside and a little yank back. Now, so far, a little close above the high of the low day. Now, with our discussion, so we can kind of attach it, the good and bad thing really about doing verticals is, and let's kind of hit Boeing with a vertical example, okay? Now, so if the investor said, James, I'm going to go bring up Boeing, and the investor says, I'm going to try to take a trade, minimum 20 days expiration. By the way, we can look a little bit farther out as well. What's the average volume? 12 million shares. And if we looked at something with 20 days expiration, and we're talking about monthly options, and we looked at a delta of 30, it's going to be about a premium bid-ask spread there, 15 cents. If we said, James, I do not want all my options to be in the same time period, and that makes sense, okay? Think about your fridge. Does all of your food expire on the same day? It's an odd example. Just a question. No, it doesn't, right? You kind of spread it out a little bit, okay? Same thing with options, okay? Now, let's say the investor said, James, I got a number of trades that are going to expire in 22 days, and what if the next 22 days are not great? Well, let's go down a little bit farther out. Now, we know if we go a little bit farther out, the premium tends to be a little higher. There's more time, okay? Now, if we take a look at this, let's say the investor said, James, I think that 195 is going to be a potential floor, okay? Where I think we could actually stay above that. And if the investor says, well, I'm going to go look at these and say, what's the bid-ask spread there? 10 cents. And if they say, look, I'm going to sell the 195 and then buy the 190. Okay? Now, in this case, you got a $1.12 credit for the Julys, and that's going to give us about a 388 risk. Whenever you actually have something like this, the profit at 112 divided by 388, you're going to get the ROR of about 25%. Many investors like to see a floor 20%, 25%, right? In this case, it's about 28%, and that's actually selling which delta. So a lot of people say, well, give me a minimum that I should expect. The answer to that question could be variant depending upon which strike are you picking and which delta are you looking at. If we're probably going delta 30 or lower, probably might expect 25, 30 or so, but that also can be influenced, of course, by the volatility and how much time you have to expiration. Now, when someone does this trade, you got to understand something, okay? So let's say I said to you, James, I'm going to do Steve Reisberg, James L. I meant to say James L, okay? Don't want you to think I was talking to myself. I would never do such a thing, okay? Now, if someone did one contract, okay, the delta on this position is 6. Now, I got a bad feeling that a lot of people might not really understand what is that even saying. And I want you to imagine if the stock went up or if the stock went down. Now, let's say imagine if we were in a market that was more volatile, okay? It's more volatile. Would the investor want higher delta type strategies like stock? Or might they consider maybe strategies that have a lower delta? Now remember, if it has a positive delta, it's a bullish position. And what we're also going to see is there's positive theta, okay? So we have positive delta, bullish position, positive theta. The gamma is so close to 0 that you can't even really tell the difference. And so what this gamma of 6 is telling us, if the stock goes up $1, the overall position is going to be up about $6 of the $112 maximum gain. If the stock then goes up another $1, we're going to be up about $12 of the 112 maximum gain. Stock goes up the third $1, we're going to be up about 18 of the 112 maximum credit here. We took this opposite, we're down about $6. $6. Okay, there you go. It's better. $6 of the 112. Now, why do some people like verticals? Dadgummit, it's a pretty kind of forgiving strategy. If it goes down some dollars here, and I meant to say 12. What was I thinking? $12. If it goes down $3, it's down about $18 of the of that credit. Or you could actually say, in this case, the downside, we could just say of 388. Okay, of the 388 here, of the maximum loss. So how many dollars down would you need to get to a max loss of 388? And the answer is a lot, okay? So in more volatile markets, investors that have experience and are willing to consider it, they're probably going to be not over focusing, but probably focusing on more vertical type trades, okay? So you need to, now, when we went to the upside, it was what was the unrealized gain divided by the maximum gain. In other words, what's the percent of maximum gain? When the stock went to the downside, 6 delta down of the maximum loss, negative 12 of the maximum loss, negative 18 of maximum loss, and so on. So it could take more variation, and it doesn't really matter as much because the delta is smaller. Why? Because you're on both sides of the you're on the side of selling and buying. Now, the major advantage of verticals is this delta can stay pretty constant. The bad part is it stays constant. The long call has the advantage if that direction is right. The vertical, that delta stays about the same. Okay, that's a major point. And I got a feeling that a lot of investors, when volatility hits, a lot of investors are not thinking about adjusting strategies. They're staying with higher delta strategies, and they're doing it unto themselves. You can pick whatever strategy you want, okay? but it might make sense, just like in golfing, that golfers have different clubs at different key points to try to score better. Now, like me, you could buy expensive golf clubs and still be no good. I know what that feels like, okay? But at least I look good. I'm joking. No, I'm not. Okay, I'm not any good. Now, here's the deal. I want us to keep an eye on Amazon. These are examples, not recommendations. Microsoft, Tesla, okay, Meta, Google. There's a couple stocks here, larger cap, that might still be trying to flag. And some of these larger caps are trying to actually bounce here. Those are examples. They're not recommendations. We're going to go ahead and send that. Now, stay tuned for our next webcast coming up right at the top of the hour. Quick reminder that next webcast is going to be short verticals, okay? And we got actually getting started with stock investing, and also after the close with Michael Fairborn. Brent Moore's class will be tomorrow on advanced option strategies, so join him as well. Now remember, with what we discussed, it was done for example, illustrative purposes only, and all investing involves risk. And today we kind of had a nice discussion on why the change of the delta based upon the sentiment and the posture that you have. So thanks so much for attending today's class on Trading the Trend. Take care. Stay tuned for our next webcast coming up next. Bye-bye.